a best place to be. Let's ask Allan Boomer. He's Chief Investment Officer at Momentum Advisors. Allan, this is your phrase here, your moniker, and I do think it's an appropriate one. So explain it a little bit and where it leaves you in terms of the market.
Sure. Thanks for having me. And listen, a year ago, we were buying stocks because there's nothing else to buy, even though we knew that valuations were getting a little pricey. Now you look at a market that's sold off a lot, and even bonds that have sold off a lot. There's been a re-rating across all asset classes, and now you can buy some things and feel pretty good about it right now. There's a lot of stocks trading at really attractive valuations, really nice dividends, and then in bonds, there's also some good fixed income out there right now. So Tara, there are some reasonable alternatives out there in the market right now.
So would you be buying bonds here after everything we just talked about, the risk that the Fed could prove to be more hawkish than people expect?
Yeah, a little. Look, I look at a yield curve that is still got some positive slope to it. And like just last week, I was able to buy in the secondary market bank CDs that are FDIC insured for 2 or 3 years, and I got a 3% rate of interest. Like I could not buy a 3% 3-year paper or 2-year piece of 2-year paper anytime in the last few years. And so I'd be cautiously optimistic that even though I'm concerned about inflation, I would expect that I get my money back, and in the future, I'll be able to put that money out and get a pretty good rate of return in the future. So again, if you're going to buy bonds, now's a decent time to buy them. You know, I would still say stocks are more attractive right now because there's a number of stocks that have a dividend yield that's even higher than what you're getting from bonds. But both, again, are a lot more attractive than they were a year ago.
Yeah, we'll circle back to some of those names in a moment. But on commodities, if you're interested in that space, do you do it through physical commodities or through equities with exposure?
Yeah, I think the easier play is always going to be the equities with some exposure. Like when you're playing commodities, you've always got to be cognizant of the fact that there's contango on a lot of commodities. And contango really just means there's a cost to rolling contracts forward, and that cost will really eat into your returns a lot. Like I used to work at Goldman Sachs years ago, and I remember one time we had a bullish call on corn, and it was the right call, but we didn't factor in the cost of rolling those contracts. And in a market where corn prices went higher, investors actually lost money because of those costs. So I'd rather be, if I was bullish on corn, I'd rather buy a company like Bunge or a company that's in the agricultural space that's actually producing the corn or the whatever the product I'm looking to get exposed to.
Yeah, I mean, imagine that you make the right call and it still doesn't work as an investment. So you can only imagine if that timing doesn't perfectly play into your hands.